So Jordan really thought he'd nailed it. He'd done the deep dives, compared the spreadsheets, and finally moved his hard-earned cash into a high-yield savings account paying a solid 4.2%. Compared to the measly 0.38% everyone else was getting, he felt like a financial genius. He was earning more than 10 times the national average. He thought he'd finally beaten the system. But here's the truth, he hadn't. Not even close. Even with that high rate, his bank was still making more off his money than he was. And the irony? The very thing the bank does with his cash to generate those returns is something Jordan could have done himself and kept the whole pie instead of just a slice of it. Then there's his co-worker Maya. She's in an even worse spot, though she has no idea yet. Maya has $20,000 sitting in a traditional savings account at a big national bank. Over the course of an entire year, her bank paid her a grand total of $76 in interest. Meanwhile, that same year, the bank took her $20,000, put it to work, and pulled in hundreds of dollars in profit from it. She got 76. They kept hundreds. And the kicker? She actually felt grateful for the service. Maya had no clue she was effectively losing money every single day. Jordan thought he'd fixed the leak, but both of them were still bleeding, just at different speeds. Today we're going to break down exactly how this scam works, run the actual numbers side by side, and show you the 3 exits any one of us can take right now. I'm Professor Wealth, and welcome back to Wealth Logic. Let's start with Maya, because her story is the one most Americans are living. She did exactly what we're all told to do. She was responsible. She built up a 6-month emergency fund, tucked it away in a big, reputable national bank, and checked her app every month. She'd see a couple of dollars land in her account, $6.33 here, a few cents of compound interest there, and it felt safe. It felt like she was doing the right thing. But her account was paying 0.38% APY, the current FDIC national average as of April 2026. On a $20,000 balance, that's $76 a year. That's not even enough to cover a decent dinner for 2. Maya probably imagined her money was sitting in some high-tech vault, just waiting for her. In reality, the second she hit deposit, that money was sent straight to work for the bank, not for her. Because this is the core business model of every bank in the country. They take your money, pay you a tiny fraction of a percent, and lend it out at a much higher rate. The gap between what they pay you and what they earn is called the net interest margin, and right now, across the industry, it's averaging right around 3%, and at smaller community banks, it's pushing 3.5%. Stop and think about what that means. On Maya's $20,000, the bank keeps a spread of roughly $600 a year just for being the middleman. And that's the average. If they happen to use her money to fund a credit card balance, where the average APR right now is 21%, the math gets obscene. They pay her 0.38% and charge someone else 21%. That's a 20 percentage point win for the bank. On auto loans at 7%, on mortgages at 6.8%, on personal loans at 12%, Maya's deposit is the fuel powering their entire profit engine. She thinks she's a customer. She's actually the supplier. But here's the part that really stings, the Treasury trade. Banks don't just lend your money out. A huge chunk of every deposit goes straight into short-term U.S. Treasury bills. Currently, 3-month T-bills are yielding around 3.7%. So the bank takes Maya's money, buys a Treasury bill, earns 3.7%, hands her back 0.38%, and pockets the 3.3% difference. For doing what, exactly? Clicking a button. That's it. The bank is buying a security that any U.S. citizen with a brokerage account can buy in about 60 seconds. Maya is paying the bank a massive premium to do something she could do herself, with the same exact safety, and keep all the interest. And don't even get me started on the fees. American banks pulled in over $12 billion in overdraft and account fees in a single year. JP Morgan Chase and Wells Fargo each cleared roughly $1 billion in overdraft fees alone in 2024. They are charging fees to the same people whose deposits they're already profiting from. Add in debit card swipe fees, ATM fees, monthly maintenance fees, and the spending data they harvest from every single transaction, and the picture becomes blindingly clear. Maya's bank isn't holding her money. They are renting it from her at the cheapest rate they can get away with, then selling the use of it to someone else for 10 or 20 times what they pay her. Now, Jordan is watching all of this thinking, glad that's not me. He's earning roughly $840 a year on his 20 grand at 4.2%, compared to Maya's 76. He's more than 10x ahead. He's winning, right? He is relative to Maya. But there are 3 big problems he's completely ignoring. Problem 1, the up to trap. That headline-grabbing 4.2% rate almost always comes with strings attached. Sometimes it only applies to the first $10,000. Sometimes it's a teaser that drops back to 2% after 90 days. Sometimes you have to set up direct deposit, maintain a minimum balance, and jump through 5 different hoops just to keep it. The bank advertises the ceiling and quietly pays you the floor. Problem 2, the tax hit. Interest from any bank account, high yield or not, is taxed as ordinary income. If Jordan is in a 22% federal bracket and lives in a state with 5% state income tax, his $840 shrinks to about $613 after the IRS and his state tax authority take their cut. Problem 3, he's still paying the middleman. His high-yield bank is doing the exact same thing Maya's bank is doing. They're lending his money out, buying treasuries with it, and pocketing the spread. They're just willing to give him a slightly bigger slice of the pie because they need his deposits to compete with other online banks. But the question Jordan never asked is, why am I giving the middleman any cut at all? Let's run the actual numbers, side by side. Same $20,000. Same 12 months. 3 different homes for that cash. Scenario 1, Maya's traditional savings at 0.38%. She earns $76. After federal and state tax, she keeps about $55. After inflation, which is currently running at 2.7%, she has lost roughly $470 in real purchasing power. She literally paid the bank for the privilege of getting poorer. Scenario 2, Jordan's high-yield savings at 4.2%. He earns $840. After federal and state tax of around 27%, he keeps $613. He's beating inflation, barely, and he's beating Maya by more than 10x, solid. But it's still bank money. Still bank rules. Still subject to whatever rate cut the bank decides to push through next quarter, and trust me, when the Fed cuts rates again, his 4.2% will be the first thing to drop. Scenario 3, a short-term Treasury bill ETF like SGOV at 4%. It earns $800. And here is the secret almost nobody tells you. Interest from U.S. Treasuries is exempt from state and local income tax. So instead of paying that full 27% in combined tax, Jordan would only owe the 22% federal, keeping about $624. He gets more money in his pocket, with the same liquidity, the same safety, and zero exposure to a bank's promotional whims. And in a high-tax state like California or New York, where state income tax can hit 9% or more, the SGOV advantage grows significantly bigger. A Californian on the same 20 grand could keep almost $50 more per year, and that gap scales fast as the balance grows. On a $100,000 emergency fund? You're talking about hundreds of extra dollars every year, just for choosing the right wrapper. The point isn't that one path always wins by a huge margin. The point is that Jordan never even knew he had options outside the bank's walls. So if you want to stop being your bank's source of cheap rent, here's the playbook. Step 1, keep your checking account. You still need it for direct deposit, bills, groceries, and your debit card. Nothing about your daily life changes. Step 2, identify your idle cash. This is your emergency fund, your house down payment, your just sitting there money. Anything you don't need this week or this month. Step 3, move that idle cash into one of 3 exits. Exit 1, a Treasury ETF like SGOV. You buy it through whatever brokerage you already use, Schwab, Fidelity, Vanguard, Robinhood, doesn't matter. It pays monthly dividends, you can sell it any market day with the cash hitting your account in 2 business days, and you keep the state tax savings. This is the easiest and most flexible option for most people. Exit 2, TreasuryDirect.gov. You buy T-bills straight from the U.S. government. 0 fees. 0 middlemen. Just pure interest. It's slightly less liquid because you typically hold to maturity, usually 4, 8, 13, or 26 weeks, but it is the cleanest, purest version of this trade. Exit 3, a Treasury money market fund. Things like Vanguard's VUSXX or Fidelity's FDLXX. They're highly liquid, pay competitive yields, and if you pick a Treasury-only fund, you keep that same state tax exemption. People always worry about safety, but here's the thing. FDIC insurance is backed by the full faith and credit of the U.S. government. When you buy a Treasury bill, you are lending directly to that same U.S. government. It is just as safe. Arguably safer because you've removed the middleman who could fail in between. Maya was responsible. Jordan was informed. But neither of them ever asked the right question. What is my bank doing with my money that I can't do myself? The answer, in almost every case, is a nothing. Nothing you couldn't do in 5 minutes from your phone. Nothing that requires their building, their app, or their $35 overdraft fees. Stop searching for a better savings account. Start asking why you need a savings account in the first place. If this video opened your eyes to the hidden math behind your bank account, hit that subscribe button to Wealth Logic and ring the bell. We are pulling back the curtain on these financial traps every single week, and the next one is going to shock you even more than this one did. I'll see you in the next video.